this topic of time value of money. Still under this topic of time value of money, of which we say that the concept refers to determination of future value, which is compounding, and the present value, which is discounting of expected cash flow. Therefore, we proceed from where we left, and I'd like you to have this time preference for money. A continuation. Time preference for money. Time preference for money. You have time value of money and then time preference for money. This concept, time preference for money. So why or when should you prefer that money, or why the reason you prefer that money, na ni utahitaji wakati gani? So you say that it is desired to have money today rather than in future. It refers to desire to have money today rather than in future. Desire to have money today rather than in future. Desire to have money today rather than in future. Time preference for money. So if you're trying to differentiate between the concept of time value of money and the concept of time preference for money, you are able to do that, since you say that the concept of time value of money, it refers to determinations of future value, which is compounding, and the present value, which is discounting of cash flow. Then time preference for money, it is that desire. It is the desire to have money today rather than in future. Desire to have money today rather than in future. What are some of the reasons for time preference for money? This one, you say that it is desire to have money today. Desire to have money today rather than in future. Desire to have money today rather than in future. Desire to have money today rather than in future. What are some of the reasons for time preference for money? Reasons for time preference for money. Reasons for time preference for money. Reasons for time preference for money. What are some of the reasons for time preference for money? Some of the reasons are maybe risk. You're fearing risk. There is uncertainty about the receipt of money in future. Risk. One of the reasons is the risk associated. For example, you say that there is uncertainty. There is uncertainty about the receipt. About the receipt of money in future. You are not sure what may happen tomorrow. Therefore, that uncertainty may require you to get that money today instead of tomorrow. At least you never know what might happen. You're not sure. Therefore, due to that risk, you need that money today. If somebody owes you money, please get it today. Then, preference for present consumption. So this is 1, 2. Preference for present consumption. Yeah, that is another reason why you require that money today. Someone can be having your money, and then when you request them to pay you back, they start asking some questions. So you have the answer to tell them, yes, I need it for consumption. I need it for, I'm fearing. Be frank to them. I'm fearing of what might happen tomorrow. I'm fearing of what might happen tomorrow. The investment. So for investment purpose, you require that money today. You cannot invest when someone else has your money. You cannot invest in with that money. You cannot invest with that money. Then I want us to look at two terms. That is real versus nominal cash flow. Remember, we have these terms which sometimes the examiner can test you. Real, so you done with this two terms, real versus nominal. Real versus nominal cash flow. Let's look at the difference cash flows. Real versus nominal cash flows. So if we talk of real, or maybe before you write that, you can say that cash flow is an accounting term that refers to the rate at which money comes into the business. Cash flow is an accounting term. That refers to the rate at which money comes into the business. That refers to the rate at which money comes into the business and goes out of business. Cash flow is an accounting term that refers to the rate at which money comes into the business and goes out of the business. So let's define nominal cash flow. We start with the nominal cash flow. We just put it down here, nominal cash flow. So for the nominal cash flow, we say that it refers to the actual dollar amount of money, that the company expects to take in and pay out without any adjustment of inflation. I will be repeating that. Say that it refers to the actual dollar amount of money that the company expects to take in. And pay out without any adjustment of inflation. So nominal cash flow does not take into account the inflation. It does not take into account the inflation. Nominal cash flow. On the other hand, we have the real cash flow. Real. People call it real. Real cash flow. We have the real cash flow. Some people call it the real cash flow. So under these, you can say that real cash flow is adjusted for inflation in order to reflect the change in value of money over time. So it takes into account the inflation. So real cash flow is adjusted for inflation. Real cash flow is adjusted for inflation. Real cash flow is adjusted for inflation in order to reflect the change in value of money over time. In value of money over time. In value of money over time. Value of money over time. With that reason, if you are an employer, somewhere, it's good to note that in this harsh condition, if you ought to add salary to your employees, please, it is not adding up. If inflation rate is 9%, and then you add your employee salary of 8%, this is not making sense. In fact, you are putting this employee into a risk, paying of high tax. The employee will be paying a high tax, and on the other hand, the employee is not gaining. So it is always advisable to check the rate of employee and then add that salary with a percentage which is higher and above the inflation. Higher and above than inflation. Kama utaki kufinyika sana on your side, najua unaweza maybe weka 10%. Sasa hapo kitu yenye employee itafaidika nayo ni 1%, because the inflation rate is, you have just added 1% to this person. You have just added 1% to this person. So if you are an employer here, please note. So when you are adding salary to your employees, please let's consider what? Let's consider inflation rate. Let's consider inflation rate. So we are are we together? Are we together up to that point, class? Are we together? Pamoja nataka tuingie kwa compounding technique. Sijika tuko pamoja hadi hapo. Have you understood that concept of nominal and real? In the real, we account for inflation, which is very important. Very, very important. We cannot disregard inflation because that is the cause of high cost of living or maybe otherwise. So let's look at compounding technique. Remember, in our previous sessions, we were looking at a discounting technique, and in this juncture, I know everyone is able to discount. So let's look at compounding technique. Compounding technique. Let's look at this compounding technique. We said compounding technique, we are trying to determine the future value. We are trying to determine the future value. We are trying to determine the future value. And class, please note, when we are compounding, you remember when we were discounting, there's those PBFA and PB formulas. And our N, number of period, was raised into a negative. When compounding, we don't raise into a negative, it's a positive. Remember, we are going in future. We are trying to go in future. We are trying to determine cash flow in future. Therefore, that formula of compounding does not have a negative. That is a major difference between compounding and discounting. So you can say that it involves determining the equivalent future value. It involves determining the equivalent future value. It involves determining The equivalent future value of present cash flow, equivalent future value of present cash flow, the equivalent future value of present cash flow, and include two aspects. It includes two aspects. So aspect of compounding. Aspect of compounding. It includes two aspects. So here the aspect of compounding. Future value of lump sum. One. Future value of lump sum. When you talk of lump sum, tunamaanisha namna gani? And then we have future value of annuity. Future value of annuity. Future value of lump sum and future value of annuity. Future value of lump sum and future value of annuity. Future value of lump sum and future value of annuity. Those are some of the aspects of compounding. Some of the aspects of compounding. So class, we can start with the future value of lump sum. Let's start with the future value of lump sum. Future value of lump sum. And I would like you to define this. So the lump sum refers to receipts or payment. The lump sum refers to receipts. Or payment. Refers to receipts or payment. The lump sum refers to receipts or payment of fixed amount of cash. Receipt or payment. It refers to receipt or payment of fixed amount of cash only once, either at the beginning or at the end of the period. I'm repeating. Future value of lump sum. The lump sum refers to receipts or payment, receipts or payment of a fixed amount of cash, only once, either at the beginning or at the end of the period. Either at the beginning or at the end of the period. But then for the new students who might have joined maybe yesterday or so, our communication, we use the chat box. There's a chat box. Your right hand side down bottom. If you have to respond, we use Y for yes, N for no. You wish to respond. If you wish to ask a question, there's somewhere with 3 dots. You can click there and utapata reaction. So if you wish to ask a question, you can maybe raise your hand. Raise your hand. Definition number 2. It also refers to periodic payment. It also refers to periodic payment. It also refers to periodic payment. It also refers to periodic payment of an equivalent amount of an equal. It also refers to periodic payment of an equal amount, not equal, the amount is not equal, an equal amount of an equal amount, just put a full stop. Periodic payment of an equal amount, just that. Periodic payment of an equal amount. Periodic payment of an equal amount. We shall be looking at that. So I want us to derive how we go about it. So annuity is given by principal amount. I multiply by 1 plus R raised to N. You see, my N does not have what? My N does not have a negative here. Tafadhali, when compounding, mtu asikudanganye, you don't put a negative sign there. Just remain as that. So where A is our future cash flow, you can say your future value, and P is the present value. Somebody to remind me what is my N and what is my R. Somebody to remind me what is my N, what is my R. Somebody to remind me what is my N, what is my R. N ni nini, R ni nini, represent what? I have to give you some time at least to respond to that. You can see Telly has responded something there. She's still saying that R is the rate. Yes, that's true. Rate of return. Somebody else, not Telly this time. Already Telly said number of years, number of period. Rate of return. Thank you so much, Telly. And then number of years. Thank you, and thank you so much. So it's as simple as that. So in this case, thank you, Faith. Thank you, Faith, for that. Number of month. No, yes. Faith, number of years. Number of years. Number of years. Number of years. So thinking about your answer, Faith. There's a time examiner atakwambia kuhusu maybe quarterly. Imekuwa compounded quarterly. If you told that the rate has been compounded quarterly, that means in every quarter you gain interest. In every quarter you gain interest. I think these will add up to 3 quarter. So if you had 10 years, we translate this one. Since it's a compounded quarterly, we multiply the number of years by 4. So utatumia 40 years. If it's compounded quarterly, find that you get more. Half yearly, you multiply this by 2. So tutaziangalia. So but generally, N represent number of period. You can say number of period. Together, thank you for that. So now this one can be illustrated as A is our future value. To get our future value, it will be given by present value multiplied by 1 plus R raised to N. So hii formula ni muhimu sana. This is what you have to take now. To get future value, you take your present value, multiply by that. So just write down, say NB, where compounding of cash flow is done more than once. Where compounding of cash flow is done more than once. Where compounding of cash flow is done more than once, like the way nimesema quarterly, more than once in a year. Where compounding of cash flow is done more than one in a year. that is a multiple period, where compounding of cash flow is done more than once in a year. You can see maybe a stroke, multiple period. This is the formula that we shall be using. Future value is equal to present value, we can multiply by 1 plus R over 100 times 1 over M raised to power M times N. Sasa, this is what I was saying, if you're told quarterly, yearly. So our M here, M represents what? Is number of times compounded, number of times compounding is done. Compounding is done. Number of times compounding is done. So ndio hiyo nilikuwa nakwambia kama imekuwa compounded quarterly, our M hapa itakuwa nini? Somebody. If it is compounded quarterly, our M itakuwa nini? Quarterly. Number of times the compounding is done quarterly. So it will be 4. Quarter is 1 over 4. So it will be 4. So hapa 4. So that means for the rate you divide by that compounding time, for the rate you divide, and for the years you multiply. If you are told that it was compounded semi-annually, what will be the value here? Semi-annually, somebody? I want to see whether you are getting the concept here. If you're told it was compounded semi-annually, now me tell you, yeah, people giving me 2 yes, semi-annually, 1 over 2. So semi-annually ni mara mbili tu kwa mwaka, right? Mara mbili tu kwa mwaka. So this will be 2. M will be 2. Those are number of times it's compounded. Si tukigawa mwaka mara mbili. Those are 2 parts. The first part 6 months, the other part 6 months. So 2 times the number of. So we shall see. So class, I would like us to have an illustration here. So hapa unaweza sema semi-annually, quarterly, and so on, monthly. Wakati mwingine unakuta hata wana compound monthly. So I'd like us to have an illustration here, a very important one here. Have an illustration. Us to have an illustration, a very nice one here. So please write down. An investor has deposited 10,000 shilling in a fixed deposit account. An investor has deposited 10,000 shilling in a fixed deposit account. An investor has deposited 10,000 shillings in a fixed deposit account. 10,000 shillings in a fixed deposit account, attracting interest of 16% per annum. Attracting interest of 16% per annum. Attracting interest of 16% per annum. Asilimia 16. But then how do Tanzania teach, by the way, with Kiswahili? Do you think it's difficult to teach in Kiswahili? Who do you think they teach? Is there anyone from Tanzania here? Is there any student from Tanzania here? Ama bado hatuna mwanafunzi kutoka Tanzania. I guess it's somehow difficult, also in the computation subjects. And full stop. Then you proceed and say, if the investment period is 10 years, if the investment period is 10 years, N is 10 years. If the investment period is 10 years, calculate the future value. Calculate the future value. So wanataka future value. Calculate the future value. Itakuwa ngapi? Total investment after 10 years. Assuming Roman 1. Assuming what? Interest is earned annually. Interest is earned annually. Interest is earned annually. Roman 2, you assume that interest is earned semi-annually. Interest is earned semi-annually. And the last one, explain any difference in your answer. Roman number 3, you just explain any difference. Explain any difference in your answer. So class, have we all copied that question? Do we all have the question? Do we all have the question with us? Do we all have the question? Collecting. Tell confirming yes. Do we all have the question? Good. Angela Mwangi, Naomi. All right, thank you. Now, I want us to solve that. We can start with the Roman number 1. Interest is earned annually. So, if the interest is earned annually, ninafuata hii. Unaona hii? You annually, you need 12 months. And just follow these. Just follow that. So, I'll be having future value is equal to, what is our present value? What is our present value? Present value is what we are doing what? Depositing 10,000. 10,000. As easy as you can see, multiply by 1 plus R. 1 plus our R is 16%. 16%. Are we going to divide here our R? Are we going to divide? Yes or no? Are we going to divide? Remember we said our R can be divided in some instances. Are we going to divide in this case? Are we going to divide? Now me anatuambia hapana, hatuwezi divide because it is annually, and we are using this formula. So 0.16, and then we raise to what? Not negative. Oops. Miaka ni ngapi? Miaka ni 10. So as simple as that, class, and you give me the answer. So what would be there? What would be the future value for interest is earned annually? Naona Naomi, you're very fast, and that is credit to you. That's a credit to you. That is very nice. 144.35. But I cannot type that maybe. Let's wait for another person to see whether the comparison or the answer are the same. So somebody else will be the second one to, that is very nice. Thank you, Jane. 44 shillings. 144.35. Thank you, and thank you so much. We move to the next part. But that is number 2. Number 2. Interest is earned semi-annually. Oh, that is very nice. When interest is earned semi-annually, so I'll just write my formula. It will be future value. Of course, just proceed. I use this formula. Present value. I just use this formula. So my present value is that multiplied by bracket 1 plus let's divide by it's semi. That means semi means 2. Tunalipa inakuwa compounded mara mbili. So for my rate, I divide with what? Rate. Tuna divide na nini? Somebody for the rate. We divide by. Taka tuende pole tu. Sikuwe na haraka. What should I divide by? Our rates. Semi-annually. And therefore, we are compounding this mara ngapi kwa mwaka? Mara mbili kwa mwaka. And that one guide me and tells me that 10 years I multiply by 2. And then whatever that I get is my complete answer. Thank you, Faith. Thank you, Naomi. So what is our answer when we when this will be compounded semi-annually? Itakuwa ngapi? Tuone. Upper speed still determine and tells a lot. Speed tells a lot. Speed and accuracy zinatuambia mambo mingi sana. So tunapata ngapi pale? Acha tuone hii maneno. Joseph Kalanja. Well, Gent, how are you, gents? Moses. Gents, Simon, umepotea sana. Let's get it. Make sure that hapa umewaki vizuri ya 1.08 raised to 20. Simple as that. 1.08 raised to 20. Or 1.08 raised to 20. Nataka kuandika each and every figure so that when you are revising, at least it will be easier for you to understand mahali hii ilitoka, imetoka wapi. Yeah. So tupate hiyo, I think tumetake dakika mingi. It's just kiwa kidogo na umemaliza. Can I pick my calculator? You know, when I pick my calculator, sasa speed itakuwa kusonga kabisa. 46,610 from Karanja. Thank you so much, Karanja. Naomi still 46,609. Okay, point. Karanja amechapa louding off. So since here we tumia decimal at 220, but that's correct. 609.57. Sasa tuone vile kunafanyika. So I want to add you another Roman before we go to maybe this one, explaining any difference. You see, kuna difference in 44,144.35, 46,609. See, there's a difference when the compounding period, time of compounding increases. That means we expect to receive more. I don't want to answer that before we do that of quarterly. So assume that the compounding was done quarterly. Please compute very fast compute the value that we expect in future if compounding was done quarterly. So everyone is doing that. After finishing this, please compound it quarterly. If compounding interest was earned quarterly. If interest was earned quarterly, mtapata nini? So let's do it very fast. Take your time. wacha tuone. Tumesema speed. Hapa speed is the keys and accuracy. Hiyo itakusaidia sana hata ukifanya mtihani wako. Speed and accuracy. Like so far nimeona watatu sawa. So now we are trying to, when interest is at what would be our value there? 48,010.2. That is from Simon. That is from Simon. 48,010.2. Thank you. Joseph still giving the same. Kalanja, gents, sahi. Where are the ladies? The ladies wamepotea. So future value, when this is interest is under quarterly. When this is under quarterly, it is easy as now. So it will be 1 plus 0.16. Quarterly, nimara, it is 1/4. So I divide by 4, I raise to 40. Of course, it should be raised to 40, and that is giving me what? 48. Moses, unaona hapo ni gents. Ladies, mko wapi? Mko wapi? Mko wapi? Mko wapi? 48. Somebody to okoa jahazi, the ladies. 010.20. So, who do you think might be the cause of the difference? You see, if compounded annually, this is the value that this person expects at the end of the period. At the end of the 10 years, atapata hii. Compounded annually. Compounded semi-annually, when interest is earned semi-annually, atapata 46,609.57. Quarterly, anapata more. See, what do you think might be the cause of the difference? What do you think might be the cause of the difference? In a layman's language, you can give us your answer. Tulisema hakuna kuogopa, contribute, give your contribution in any way. Don't fear. Don't fear. Just give your contribution. What do you think could be the cause of that? You see, the others change. Kama 2000. Kuna kakitu. Based on fixed deposit amount, interest is paid many times a year. Thank you so much. Remember, thank you so much, Joseph. That is well done. Remember, we have placed this money in a fixed deposit. That means once we get the first interest, the money goes up. Mara ya kwanza. Ndio maana hapa ilienda juu na mara moja. Lakini hapa ikaenda juu kidogo kwa sababu we had two times. The interest yenye tulipata tukaongeza kwa our principal amount, we earned interest on it. So you are earning interest on interest, and that is the cause of the increase in our value at the end. As simple as that. As simple as that. We are earning interest on interest. We are earning interest on interest. So the more the period, the more the compounding time period, the more the money, because your interest in a zana. So to use that word, it is yielding something on top. It is yielding something on the top. So are we together? Have you understood why the cause of the difference? Have you understood the cause of the difference, tafadhali? Have you understood the cause of the difference? Have you understood the cause of the difference? Have you understood the cause of the difference? Umeelewa cause of the difference? So you can write it down, say that the difference is caused by the compounding effect. The difference is caused by the compounding effect. The difference is caused by compounding effect, i.e., the difference is caused by compounding effect. i.e., or that is, anytime after the first period, interest is earned on interest. Yes, that's very nice. So if you want to invest, let the number of times of compounding at least ikuwe mingi kidogo. Unauliza huyo manager, tuna compound mara ngapi kwa mwaka? Ndio mara 4. Unajua kwamba what you expect if you are to compound semi-annually, you get more than what you expected. So the difference is caused by the compounding effect, i.e., anytime after the first period, interest is earned on interest. Interest is earned on interest, and the principal amount invested. Interest is earned on interest, and the principal amount invested. Hence, more the number of period, the higher the interest earned. Hence, the more the number of period, the higher the interest earned. The more the number of period, the higher the interest earned. The higher the interest earned. So class, that is under future value of lump sum. So I want us to look at future value of annuity. Future value of annuity as our next aspect. Future value of annuity as our next aspect. Future value of annuity as our next aspect. Future value of annuity as our next aspect, and we say the term annuity refers to receipts or payment. The term annuity refers to receipts or payment. Of fixed amount of cash flow. Over a given period of time. The term annuity refers to receipts or payment of fixed amount of cash flow over a given period of time. It also refers to the payment. It also refers to the periodic payment. It also refers to the periodic payment of equal amount. Here, the amount is equal. Periodic payment of equal amount. Periodic payment of equal amount for a given duration. It also refers to periodic payment of equal amount for a given duration. For a given duration. NB, note better. If made at the end of the year, is known as ordinary annuity. If made at the end of the year, we call it ordinary annuity. So, illustration. Let's have an illustration here to help us understand it more. Illustration. So say that calculate the future value of 1 shilling. Calculate the future value of 1 shilling. Calculate the future value of 1 shilling invested at the end of each year invested at the end of each year at an interest rate of 12% per annum. Invested at the end of each year at an interest rate of 12% per annum. I'm repeating the whole sentence. Calculate the future value of 1 shilling. Calculate the future value of 1 shilling, shilingi moja. What will be the future value of 1 shilling? Maybe in the next 5 years, 10 years, we compound it. Calculate the future value of 1 shilling invested at the end of each year. At the end of each year. So you're the ordinary annuity, right? Invested at the end of each year at an interest rate of 12%. At an interest rate of 12%. At an interest rate of 12% per annum. 12% per annum for 5 years. For 5 years. For 5 years. At an interest rate of 12% per annum for 5 years. For 5 years. Wow. That is very interesting. For 5 years. So what will be the future value of 1 shilling? Compounded at a rate of 12% per annum for 5 years. So yeah, this is a R, N, and maybe the amount is 1 shilling. 1 shilling. So maybe to solve this, you can see that here we have here. Then so you have here. You have cash flow. Cash flow. Remember we are compounding this. Remember we are compounding this, and we know how we get there. We know how we get the future value. So to get the future value given by present value times 1 plus R raised to N. So you can have that formula. Let me just okay, so in this case, our present value hapa ni ngapi? Ya kwanza ni 1. Of course, our present value ni 1, 1, 1, 1, 1, 1, 1, 1, 1, 1. But I want you to understand kitu kidogo hapa. So it will be 1. Nachukua hapa. Hapo. 1. 1.12. 1.12 raised to what? Somebody. Tunataka twende hadi mwaka ya 5. Tunataka twende hadi mwaka ya 5. So, mwaka ya 5, are we going to compound? Remember, this is done at the end of each year. Are we going to compound mwaka ya 5? Are we going to compound mwaka ya 5? Ama it remain the same? Tutakuwa already tumefika hiyo future, Tutakuwa already tumefika hiyo future. So kitu yenye nataka uelewe hapa ni kwamba when we are trying to compound the annuity, the end year, the end period, that end period we don't compound. So if you want it to remain the same, it must be raised to power 0. It must be raised to power 0. Therefore, if you're having 5 years, for us to make sure that the last year tuko na raised to power 0, lazima tuanze hapa ku raise na power 4. If you have 6 years, lazima uanze na ku raise to power 5. Ili the last year you raise to power 0, because we don't compound. They remain the same. 7 years, lazima u raise to power ya kwanza. So in our case, we have 5 years, therefore we raise to power 4. 1.12 raised to 3, 1.12 raised to 4, or not 4 but 2. 1.12 raised to 1, and 1.12 raised to 0. That's it. So maybe to one decimal place, we can now get our future value. Future value ya kwanza unapata ngapi? One decimal place. Tunaweza enda na one decimal place. So itakuwa 1.12 raised to 4 ni ngapi? One decimal place ni sawa. One decimal place ni sawa. Pata ya kwanza, mwingine aende ya 2, mwingine aende ya 3, of course ya 5 hii inakuwa hii 1, inakuwa 1.1. Haya tuende hizo zingine, ipatie ya 1 ya 1 2 3. Ya 1 2 3 what do we have? Ya 1 2 3 what do we have? Pate pale. Let's do it very fast so that we move to the next item. Kuna 1.57 ya 4. Itumia tu hizi ya 1. So hiyo ni ya 1. Okay, yes, we raise to ya 4 since it's a compounding. Ya 1 is 1.6. 1.6. Ya 2 this one. 1.12 raised to 3. Takuona shilingi moja kwa miaka 5 itakuwa ime earn gapi? 1.4. 1.4. The last one ya mwisho tukimaliza tukisonga. Thank you so much Simon, thank you so much Moses. Ya mwisho tukisonga 1.3. And then you add, itakuwa the future value. Total ni ngapi? Should I adjust my camera here? You see. Total itakuwa ngapi pale? Shingapi? 6.4. Confirm. Unaona hii venye tumefanya hii ni kama kusema PVFA si ni annuity. PVFA 12% 5 years. PVFA 12% 5 years. PVFA 12% 5 years. So it will be 1 times 1 minus 1 plus R, which is 1.12 to this power negative 5. All this divided by 0.1. Hebu mtu fulani atufanyie hii, tuambie anapata nini? 6.6. Okay, 6.6. I confirm your figure. Somebody to do for us this 1 minus. Iweke kwa calculator haraka. Na mimi ndio umefanya hiyo kupata in fact should we hebu fanya hiyo tuone utapata nini. Inaleta Jen, hiyo ni hii Jen ndio ameleta. No, hii unapata nini? Fanya hii. Somebody use a calculator and tell me what you're getting. what you're getting. Unapata ngapi? Oops, hata usifanye hii. Hata usifanye hiyo. Hata usifanye hiyo. Fanya ikiwa hivi. Fanya ikiwa hivi. 1 times. Now, since we are compounding, right? So for the compounding, you start with that 1.12 raised to 5 minus 1 divided by 0.12. Fanya hiyo sasa. Fanya hiyo sasa. 1.12 raised to 5. Usikue na negative hapa. So that means formula itakuwa hivi. Formula ya hii itakuwa 1 plus r minus 1 divided by r. Haya, unapata ngapi? 6.4. So you see, tumia hiyo na hii, you getting the same thing. So formula ya annuity ni hii. Formula ya annuity, you want to apply the formula is 1 plus r minus 1 over r. It's almost the same na ile ingine ya discounting. In your compounding, under compounding, you want to compound annuity. Remember ya annuity ilikuwa ile ya discounting ilikuwa E21 tunaileta hii side 1 minus. Umekumbuka? So ni rahisi tu hivyo. So you just exchange where the position of 1, the position of 1, position of 1. Get the same thing. So that is it. Assume that you given 20,000 and you are told now to determine the future value. Given 20,000, you told to determine the future value. So utakuwa hiyo times 4. So a future value itakuwa so if 20,000, maybe if you wish to write, you can say that if 20,000 is invested at the end of each year for 5 years at an interest rate of 12% per annum, the future value will be if, I repeat, if 20,000 is invested at the end of each year, if 20,000 is invested at the end of each year, for 5 years at an interest rate of 12%, at an interest rate of 5%, 12% per annum, the future value will be given like this. Hii ilikuwa ya 1 shilling, sasa hapa ndio tunaweka 20,000. So kwa hiyo you multiply. So itakuwa ngapi? If 20,000 was invested at the end of each year, what will be the future value? Somebody to give us this 128,400. 128,400. So itakuwa it's like present value times PV 12%, 5 years. Ukumbuke hii compound, compounding. So to get this PV is 1 plus r. We andike mahali to bracket list to n minus 1 divided by r. Get that. So class, are we together? 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 Hii mmepata 128. Kila mtu wa confirm kama mmepata 128. I hope mmepata hivyo. Kila mtu. I hope mmepata hivyo. There's somebody who have not talked to us since morning, and that is not healthy discussion. A healthy discussion is where everyone is contributing. Let me see. Patricia, have I seen your answer? Mahali? Marine, have I really seen your answer? Mary Wanyaga. I think Mary Wanyaga nimeona mahali. Okay, Margaret Bolo Kalanja. Karanja. Let your names be displayed here on those answers, at least that tujue uko pale. So that is it as far as future value of annuity is concerned. As far as future value of annuity is concerned, please let me get a confirmation. Whether we are all together at that point. Are we all together? Are we all together? Are we all together? Are we together up to that point? Are we really together? Before we give illustration number 2, please confirm whether we are together. We're almost there. Good, thank you so much. So let's continue with illustration number 2. We're almost done with this topic. Tukishamaliza hii sasa. Hizo ndizo basic. Once you get the basic, itakuwa sawa. Okay, just write down this illustration number 2. An amount of 2 million shillings. An amount of 2 million shilling is expected after 12 years. Examiner atakuletea swali kama hili. An amount of 2 million shillings is expected after 12 years. Is expected after 12 years. Full stop. Calculate the amount to be invested today. Calculate the amount to be invested today. Calculate the amount to be invested today in a fixed deposit account at an interest rate of 8%. At an interest rate of 8% per annum. In short, wanauliza nini? What is our 2 million? Is it the present value or the future value? Thank you so much, Naomi. Yes, the 2 million ni future. Umetupatia pesa ya future. Situjaribu hiyo tafadhali. Tujaribu hiyo. Test yourself. With the knowledge that you have, now try to get the present value. What are we going to invest today? So that at the end of how many years? I'm going to repeat this again. 12 years, tutakuwa na 2 million. An amount of 2 million shilling is expected after 12 years. To stop. Calculate the amount to be invested today in a fixed deposit account at an interest rate of 8% per annum. Class, let me give you 5 minutes. You attempt that. Once you're done, display your answer there. Remember, you are practicing field is the chat box. That is the field that Zoom allows you to practice. So have the 5 minutes to maybe sip a cup of water or tea, and the tea should be cold, and then you make sure that you finish that. Display your answer there. Are we in agreement? You attempt that, You attempt that. You ni rahisi sana. Mbona ipatia hapa? Tafadhali hapa hivi. Wale watu wa chap. I think I need to do. Wale watu wa chap. Hii unapata ngapi? kamera yetu kuleta nyefu. So somebody to compute that, tafadhali. As I adjust this battery hapa, naona imetaka kusema imechoka, but safari bado. Aha. So I have to wait for some time. For it to get fixed.